If a prop firm ever calls your trading gambling, it usually has nothing to do with your win rate. It is about one thing. Your trading looks random or fragile. Like if one mistake could break your account. Think of it like this. A trader uses risk like a seatbelt. A gambler uses risk like a rocket button. Both can move you forward, but only one has a high chance of blowing up when something small goes wrong. And here's the tricky part. You can have a good strategy and still get labeled as gambling. Because the label is about how you place the bet, not only if the bet wins. So in this video, I am going to show you the exact behaviors prop firms read as gambling and how to avoid them using simple math and simple examples. First idea, prop firms do not hate risk. They hate risk that is too big for the account because big risk turns your account into a coin flip. Here is the simplest version. You have a 100K account. If you risk 1%, that is 1K. If you risk 3%, that is 3K. Now ask yourself, how many normal losing trades can you take before you hit a rule like daily loss or max loss? If your daily loss limit is 2K and you take a trade with a 1.8K stop, that is not confidence. That is basically betting your entire day on one moment. Even if you win, the pattern is what matters. Props on a trader who can survive a bad day. A gambler tries to skip the whole journey with one big hit. And many firms literally measure this. Some will flag you if your open risk is above a certain level, meaning the amount you could lose if all your stops get hit. So you could be in profit at the moment and still be labeled as gambling because your open risk is huge. Second idea, they also look at margin and leverage like a danger meter. If you use most of your margin on one idea, your account becomes fragile. A tiny move against you can create a large loss fast. Think of it like carrying a full cup of water while running. Even a small bump spills everything. Some firms talk about this as over-leveraging or excessive margin usage. In normal words, it means you're driving too fast on a road with speed bumps. Third idea, gambling is not only about one trade. It is also about the story your trades tell over time. Here is a pattern props hate. You take one big trade, then you lose. Then the next trade is even bigger. Then you lose again. Then the next trade is even bigger again. That is called doubling down. People also call it martingale. Props read this as pure emotion, not skill, because the size is not coming from a better setup. It is coming from the pain of the last loss. Simple example. On a 100K account, you risk 1K on trade 1. You lose. Then you risk 2K on trade 2 to get it back. Now your second trade is not about your edge. It is about your ego. That is what gambling looks like to them. Fourth idea, one-sided betting. This one confuses people because it sounds normal at first. One-sided betting is when your whole account performance depends on one direction or one event. Like you only take longs for days and you size up huge because it has to go up. Or you stack multiple trades that are basically the same bet. You might think you are diversifying because you traded different markets. But if they all move together, it's still one bet. Simple example. You open positions that all depend on the same thing. If one macro move hits, all positions lose together. Props will call that overexposure. Again, not because you are evil, because the risk is concentrated. Fifth idea, news lottery behavior. This is where people try to turn the market into a slot machine. They place big orders right before a high-impact event and hope for a spike. Some do it with 2 pending orders, one above price and one below price. Whichever side triggers, they hope it runs. Sounds clever, but props hate it because slippage and spread changes can make the results random. And random is the opposite of a stable trading model. Props want trades that make sense even when conditions change. A 1-minute explosion around news is not stable. It is a lottery. Sixth idea, the prop firm version of gaming the system. This is where it gets serious, because some behaviors are not just risky. They look like you're trying to beat the rules instead of trading the market. The biggest one here is account rolling. There are two common versions. Version 1. You buy an account. You trade it with crazy risk. If it fails, you buy a new one and repeat. You're basically buying attempts, like buying more lottery tickets. Version 2. You buy many accounts. You pass a few. Then in funded, you trade them one by one, pushing each to the edge. If one fails, you move to the next passed account. Same idea. You are treating accounts like disposable tries. Why do firms hate this? Because it is math, not skill. If your strategy has a low chance, but a big payoff, you can brute force it by buying enough accounts. The firm does not want to reward that. They want one trader, one plan, sustainable risk. Seventh idea, hedging across accounts. This one is a quick way to get flagged. If you buy on one account and sell on another account at the same time, you have reduced your real market risk. Now you're not trading. You're trying to lock in a rule advantage. Some firms call this reverse trading or group hedging. Either way, it is usually banned because the firm is not testing your skill anymore. They are watching you build a synthetic, risk-free setup across accounts. And that breaks the whole point of an evaluation. Eighth idea, copy trading and coordination. Copy trading is not always banned everywhere, but copy trading across too many accounts, or copying someone else, or coordinating a group to hit the same trades can be a problem. Why? Because it creates one big wave of identical orders. From a firm side, that looks like toxic flow, meaning it can stress systems, create execution issues, and increase the firm's exposure in one moment. Props want many independent traders, not one army moving as one. Ninth idea, hyperactivity and ultra-fast trading. Not every prop hates scalping, but many hate extremely short holding times combined with high volume. Why? Because it can look like you're exploiting execution speed, tiny price moves, or platform quirks. Some firms even set rules like minimum hold time, or they check that a good portion of your trades are held more than 1 minute. Not because 1 minute is magical, because it filters out the most casino-style click spam. Also, a lot of orders and modifications can overload servers, so they may watch the number of trades or even the number of messages your account generates in a day. If your style creates chaos, you look like a problem, not a trader. 10th idea, exploiting errors. This is the fastest way to get terminated. If you trade obvious platform mistakes, delayed quotes, or price feed glitches, firms see that as abuse. Even if you tell yourself it was available, so I took it, they will say you are not trading the market. You are trading their infrastructure. Now let me give you the clean takeaway. If you want to avoid being labeled a gambler, your goal is to make your trading look boring in the best way. Boring means repeatable. Repeatable means your risk is small enough that you can take a normal losing streak. Here is a simple framework you can follow. On a 100K account, keep risk per idea small enough that 5 losses do not end your week. That usually means you're not risking 3K on every trade. It means you are not using most of your margin at once. It means you are not stacking 10 trades that are secretly the same bet. It means you do not try to pass a challenge in one trade. Because all in to hit the target is exactly what many firms call gambling. It means you do not buy 5 new accounts because you blew the last 5 using max size. And it means you never hedge across accounts to create a fake risk profile. If you trade like a business, you stop looking like a casino customer. Now quick pause. If you want the list of the best prop firms and promo codes, the link is in the pinned comment. Check them and support my work. And if you want more videos like this that explain prop rules in plain language, Like and subscribe now so you do not miss the next one. Back to it. A lot of traders ask, but what if I am profitable with big risk? Props do not care about one screenshot. They care if your method can survive bad luck. Because even a good strategy can have a bad streak. If your sizing cannot survive that streak, it is not a strategy. It is a time bomb, and props can spot that by looking at your worst case risk, not your best case win. So the real question is not, can I win big? The real question is, can I lose small? Because losing small keeps you in the game long enough for skill to matter. One more simple example to lock this in. Imagine two traders on 100K. Trader A risks 500 per trade. Trader B risks 5K per trade. Trader B can look like a genius on day one. Trader A looks slow, but after a normal set of losses, Trader B is gone. Trader A is still standing. Props are built to find Trader A. Not because A is timid, because A is survivable. That is what a real firm wants. So when you read a prop firm rule and it says no gambling, do not get emotional. Translate it. They are saying, do not make your account performance depend on luck, glitches, or one huge moment. Make it depend on decisions you can repeat next month. And that is the real difference between a trader and a gambler in the eyes of prop firms. Now, if you want the list of the best prop firms and promo codes, the link is in the pinned comment. Check them and support my work. And once again, like and subscribe if you want more simple breakdowns like this, because the next video will go into the exact trade patterns that trigger consistency rules and payout reviews.